Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, in today's video, I am going to talk of a huge structural shift unfolding in India and the companies that stand to benefit from it. A few months ago, I was approached by a financial journalist to share my views on crude prices in the future and about where I see the investing opportunities considering the high crude prices. I shared the comment. This was with full disclosure that I have no clue about oil prices, where they will be a few days, a few weeks, or even a few months from now. I had no stock names to offer based on oil prices because I do not believe it's a reliable reason to pick stocks. Now, as I write this, the oil prices have hit 7 months lows, and it has taken down with it the valuations of potential beneficiaries, the upstream oil companies. In contrast, the market cap of BSE listed firms is touching all-time highs. The Sensex has gained 16% from June 2022 lows, and the small cap index is up 26%. The FIIs are back. The amount they have invested in August alone is over Rs 500 billion. The concerns about Fed interest rate hikes have moderated, corporate profits on the road to recovery with inflationary pressures easing. Indeed, there has been a rebound in the stock prices that no one was anticipating. On the other hand, the entire narrative about commodity supercycle has lost relevance as prices of steel, oil and other commodities has cooled down. The SPAC proponents have disappeared from Twitter and so have their followers. The crypto experts and young millennials whose financial investment journey started with Dogecoin are learning new lessons. And yet, little has been learned. Unfortunately, a lot of print space and prime time is wasted on predicting macros and cycles and taking cues from it to pick stocks. This is a highly complicated exercise that no one has been consistently good at. This reminds me of the famous saying by John Kenneth Galbraith that there are two kinds of forecasters, those who do not know and those who do not know they do not know. Instead, if we spend the same amount of time, energy and effort in spotting structural shifts in the economy and industries and companies they would benefit, we believe we would be a lot better off in terms of investment returns. Today, I am going to talk about one such structural shift that could create huge wealth for companies in India. I am speaking of shifting supply chains, the diversion of trade from other economies to India in the post-pandemic era and the beneficiaries of the same. These shifts were always happening, but at a much gradual pace. They have picked up pace for three key reasons. What has happened amid COVID is that global economies with over-reliance on one supplier, specifically China, have seen their supply chains breaking and their prospects dwindling. With this shake-up, these corporates have decided to diversify and broaden the outsourcing. In fact, not just corporates, even the global governments are coming up with regulations that discourage dumping from China. India has been a key beneficiary of this. A case in point is textile industry where many players like Trident and Arvind are benefiting. India's share of exports to the US in apparels has increased as compared to other countries from 28% to 36% this year. The second factor is Indian government's thrust on Make in India. The government is coming up with policies that are protectionist in nature. These include imposing anti-dumping duties on flat-rolled products of aluminium, sodium hydrosulfide which is used in dye making, silicon sealant which is used in the manufacturing of solar photovoltaic modules and thermal power applications, HFCs or hydrofluorocarbons which are used in refrigeration industry, rubber chemicals, APIs and so on. Companies such as NoSeal, Nalco, Aarti Drugs have gained on these developments. Then there is thrust on more share of domestic in manufacturing sector. PLI schemes that offer support on capital investments and subsidies are a way to achieve this. Electronic sectors and companies like Dixon will benefit from the same. Another case in point is defense sector that is undergoing indigenization or use of domestic components in the defense manufacturing. This could be positive for companies in the defense sector such as HAL, Guard and Reach Shipbuilders, Aventel, Data Patterns and Bharat Electronics. Of more than 10,000 items that were earlier imported have now been laid on a portal for indigenization. Of these, interest has been shown for over 2,800 components. With events such as Russia-Ukraine war and India's own tensions with its neighbors like China, this trend is set to gain momentum. The third factor is factors intrinsic to China. Stringent norms related to environment, hike in the wages, cut down in government subsidies and shutdown of cities and curtailment of the key ports amid a recent lockdown and a zero-tolerance policy towards COVID has led to destabilized supply chains. In crux, a huge opportunity is unfolding for certain industry and specific businesses based in India. So let us now move on to the specific companies that are witnessing tailwinds from this phenomenon. The first is a small cap company, Gokaldas Exports. The company is into designing, manufacturing, and sale of a wide range of garments for leading international fashion brands and retailers in over 50 countries, with clients like Gap, Walmart, JCPenney, Adidas, H&M, Marks Spencer, Puma, and Old Navy. The company has seen increase in the wallet share from its top 3 clients. For new initiatives, capacity expansions, and plant upgradation, the capex envisaged is Rs 3.7 billion. The stock is down almost 30% from its 52-week high, available at a PE of 14 times. Its net debt is negative and it has cash and cash equivalents of 2.4 billion, almost 11% of the market cap. And the return on equity and capital employed are 23% and 18% respectively. The cash flow from operations are positive. The management expects the business to benefit from continuing shift of global sourcing away from China, supply consolidation towards efficient and well-capitalized players, supply-side instabilities in countries like Sri Lanka, Pakistan and Burma, favorable currency movements, and announcement of PLI and signing of free trade agreements with the key markets. The second stock on this list is Maharashtra Seamless. The company enjoys an almost 55% share in seamless pipes that are primarily used in the oil and gas industry, along with ERW pipes used in city gas distribution, sewage and housing projects. Under Atmanirbhar Drive, any purchases made by PSUs that also happen to be the key clients for the company have to have a 35% value addition by domestic players in the supply of pipes. In fact, for tenders up to Rs 2 billion, only domestic tenders will be floated. Under another protectionist measure, anti-dumping duty has been imposed on imports of seamless pipes from China for the next 5 years. China itself has removed a rebate of 13% for exports for its manufacturers. Not just domestically, but the company's products are witnessing strong demand from export markets like US and Europe as India fills the gap amid sanctions on Russia and absence of Ukrainian suppliers in the market. The stock is available at a PE of 13 times and with a return on capital of 13%. The debt to equity stands at 0.2 times. The insiders have increased stake in the June quarter and the management commentary on growth guidance is strong. The third stock in this list is Shelly Engineering Plastics. The company makes and sells injection molded precision plastic components which are used in home furnishing, auto sector, medical sector and other industries. In the recent years, it has ventured into toy manufacturing. Earlier, China used to be manufacturing hub for global toy companies. However, the hunt for an alternative supplier has opened doors for a new business vertical for the company. In the initial years itself, Shell is working with global giants like Spin Master and Hasbro. And the other factor that are expected to drive the business significantly are increased revenues from medical devices such as pen injectors that have high margin. The stock has an ROC of 14%, the debt to equity is well below 1, but the stock is trading at a PE of 54 times. Now do keep in mind that the inclusion in this list does not imply a buy view. I would recommend you to do due diligence at your level. So these were just a few examples that I believe have received less limelight than others. However, the opportunity is huge and there would be many beneficiaries across industries that could gain from this tailwind. I would strongly recommend you to watch out for the same and pick the potential beneficiaries with enough margin of safety in valuations. With this, I have come to the end of this video. If you found it useful, do let me know through your comments, likes and shares. For more such updates, subscribe to Equitymaster YouTube channel. Goodbye and have a good day.